Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although this could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future results.
Well, good morning, good afternoon. Welcome to Develop Your Edge with Anthony Crudele. I'll be your co-host, Tom Schneider, CMT with NinjaTrader. And on this show, we like to look at how you can improve your trading edge. But we can't do that without the star of the show, Anthony Crudele. So let's welcome Anthony back to the show. Good morning.
Tom, everybody, Happy New Year. Let's get it out of the way. I hope everybody has a great year. And how you start the year, in my opinion, not only how the market starts the year, but how you as a person starts the year is very important. And that's what we're going to discuss today.
Awesome. Yes. Happy New Year to you and everybody watching. Good to get it out of the year, out of the way early. I don't know how long people say Happy New Year, but let's put an end to it and ready to work this year. Really good.
Yeah, I'm ready to get back to my screens. And I think a lot of people are. And that eagerness, I think, is going to be a weakness for a lot of people. And that's what I want to start off with today. We're going to get to the charts, everybody. We're going to talk about the January impact and all of that. But it's about setting the tone first on a mindset for a trading year. And for me, I put a tweet out the other day. I said, I've been trading a lot smaller than I have been as of the last several months, because as you get into January, I want to ease my way into the year. And I talk about rhythm. Rhythm is a very understated skill or mindset or whatever you want to call it when it comes to trading, because as traders, we all know we can get in this funk where we're just, everything we touch is a loser. I feel like I just came out of one of those kind of a little bit at the beginning of December. And then you get in, then you can get into a rhythm where everything you touch is kind of good, right? And so you can get into these funks. And a lot of it really starts with the base of you just making good decision making. Good decision making is contagious, so is bad decision making. And you can get out of sorts if you start trying to do too much too early. That is a mistake I've made many times at the beginning of the year. And I've really seen it carry throughout the year, because you always feel like you're chasing, or you always feel like this something in the back of your shoulder where you're just constantly like this little itch or tick behind you that you just can't really kind of scratch or get off because you started the year wrong. And because I've been down this road so many times, that rhythm is such an important element to the year for me. And so it's about being really small, managing the losses even better than we normally do, because we want to build a good decision-making rhythm. And that is just so important from even as a day trader who's coming in every day, to really just slow things down is what I'm trying to get at. Is that eagerness, as I said, is a weakness, is because you come in and you feel the need to want to do something. There's action, and you've been sitting with your family and you're ready to come back and click buttons. And you've just really got to slow things down. And how do you do that? Well, how you do that is you find your plan. And so, Tom, maybe before we get to the charts, maybe we bring you in a little bit and just talk about just that initial mindset of slowing things down to begin the year.
Yeah. So, I know people call it revenge trading. I call it the makeup trade, right? Where if something doesn't go your way, now you're behind where you think you should be and you try to make it up. And that could lead to decisions. Like you said, there's an urgency to make something back that you didn't anticipate before. And so that leads to, I think, not a great mindset. Like you said, it kind of speeds things up. You want to be urgent to trade, to make up the lost time or the lost trade that you had, when in reality, you don't need to do that. You can slow things down a bit.
Yeah, it's so important to build on a year. And I just can't stress this enough. I mean, I remember so many years of my career where I've started the year off really strong and then I've got way ahead of myself and then I give the whole year back. And the next thing you know, I'm chasing that. Or I start the year off really bad, then I try to make that back. And next thing you know, I get that back and then I'm down to the same amount I was down originally. And I'm back and forth in this vicious cycle. And it just gets very extremely frustrating, which is why I keep saying to myself in my notes, slow things down, develop a good rhythm, because if you think long term, your short-term results will get better. It's very important, even as a day trader. You have to think long term because that's where your decision making will slow down because of that thought process. And intraday, knowing right when the bell rings, you instead of feeling like you have to click, you will click when it makes sense to. And that brings me to the charts. So what I want to do is I want to go over the process. I want to first off say I'm short the E-mini S&P. I've been short since the first day of the year, and I'm going to continue to stay short until I show you some reasons that would tell me otherwise. And one of the things that I've been doing is staying short in a very small position to be able to stay directional, because I think that the January impact is really, it's a real thing. It's not necessarily that January, what it does in January will have an impact on the entire year, but there is that opening year trade that will a lot of times stay in that trend for a period of time. I remember last year it was similar, even the year before. You get these first month, 2, or even 3 where the market can just trend in one direction. And you get a lot of people that'll come in and they'll just try and just fight it too much instead of just saying, look it, a lot of times people will come into the year, big players, and the flows will be consistent. And we don't know if they're going to be buying or selling. So far this year, everything that I've seen has been bearish. And so I've been taking on very small short positions and trading around a core position to the short side. And let me explain why. First off, we're going to look at the daily chart here in the E-mini S&P. The premise of my strategy, as many of you know that have watched Develop Your Edge, is daily Bollinger Bands. That's where everything starts. If you follow my morning note, which is free in my Discord, every day I really talk about what is the boxed out area or the zone that I'm looking at, and whatever that bias of direction is, which comes from a daily chart using Bollinger Bands. And we've talked about this so much on the show before. When Bollinger Bands are opening up like a mouth, that's range expansion. When Bollinger Bands are pointing inward, that is range contraction. That means mean reversion. And so when we look at the markets on a daily basis, you can go back and see at the end of last year, we obviously had that just straight up rally. And next thing you know, you get into the last day of the year, the first day of this year, the market has turned back down. I use a simple 5-day moving average. Sometimes I'll change it even to a 10-day. That really doesn't matter too much to me if you're using a 5 or a 10-day. It's just a short-term moving average to gauge market sentiment. What is the market doing on the average? I've been using a 5-day because it's just keeping it a little bit tighter. We crossed below that, and the Bollinger Band started to come inward. What do? I take my Fibonacci retracement. I draw it from the bottom peak to the top peak. Important to have peaks. The bottom and the top Bollinger Band have to be coming inward. And then I look at this shaded area. And what this shows me is anytime we're in this 30% to 50%, so I should note if you're new to the show, when I look at this, on the fibs, it's 30, 50, and 70%. And those are my support and resistance levels, basically my pivot levels as well for the indexes and really any market that I'm looking at on a daily chart. And so when you see that we're below the 30%, which means we couldn't get in the top 30% of this Bollinger Band peak, we a lot of times revert back to the 50%. So instead of looking at a 50% retracement on price, I look at a 50% retracement on volatility. Okay, so the bottom peak and the bottom peak of Bollinger Bands were going outward as the market was trying to make a high. Then when they started to revert back in, 50% of that volatility comes in right around 4,700. Okay, now some of you are going to have different charts, different Bollinger Bands. I use a 20-period, 3 standard deviation Bollinger Band for my charts. Now, once this happens, I have this shaded red because that means bearish to me. Okay, so now I see we're below the 5-day moving average, and I look at this and say, okay, we're also in this bearish look, telling me we're targeting just right around 4,700-ish. Okay, next I'm going to go to the NASDAQ. And the reason why I'm going to go across all the indexes before I even begin to trade the E-mini S&P, because that's going to be my primary market, I want to see what the other indexes are doing. If you remember back in last year, we had a lot of divergence. Let's not forget how much divergence we had last year. We had Russell weakness, Dow weakness. The next thing you know, end of the year was Russell strength, Dow strength. We had NASDAQ leading to the upside. We had a lot of divergence throughout the year, which a lot of times for day traders can be a little tricky because you're going to get a push and pull in the E-mini S&P. I've talked about this for decades. It's probably one of the first things my mentors taught me was that divergence between the major indexes and how the S&P is really the center of the universe and will feel that impact from all of the markets. So you want to see what the other indexes are doing. And when you look at the other indexes, right now the NASDAQ, the opposite of last year, but although the same mindset, this year the NASDAQ's the leader to the downside, but still the leader, right? So the mindset is the NASDAQ is still leading to the downside, and it's not necessarily because the NASDAQ's moving quicker or faster to the downside because it's a more volatile market. It's because it's already moved below my 50% line. So anytime you compare indexes, I think this is extremely important. Don't compare the move of the NASDAQ of the S&P to the Russell, to the Dow. That is not what you look at. Compare it on a support and resistance level basis. Compare it on an indicator basis, because the NASDAQ's volatility is very different than the S&P, and it's different from the Russell, and so on and so forth. So when you compare apples to apples, we're already below the 50% of the volatility, which means that the NASDAQ is leading the downward trajectory of the move, and the S&P is lagging in that sense. Next, we'll go to the Russell. And we look at the Russell, which had that massively strong rally going towards the end of last year, has now equally had a the weakness in this break, which is not quite as weak as the NASDAQ, but it is a touch weaker than the S&P, and it has been rolling over somewhat significantly and actually getting pretty close to their 50% line. Okay, we look at the Dow as well. The Dow, to me, when you look at it, I don't have my fibs up on it because I'm not looking at it as closely. The Dow market is the one I follow the least. It's sitting right at its 5-day. I still feel like the Dow, because so many of these Dow stocks are in, NASDAQ and S&P, the Dow is less relevant to me. I really primarily follow Russell, NASDAQ, and S&P. But the one thing I want to note is the 10-year. This is extremely important. I put in my note, and I put this on social media. You look at the 10-year. The 10-year has the same basic look as the E-mini S&P, pretty much similar to the NASDAQ and the Russell as well. Bollinger Band started to come inward. This moving average is different because I look at the moving average different. I actually have a 20-period moving average up on the 10-year because it's just not as volatile. And I could take this down to a 5-period moving average, apply it just to show you what it looks like, and you can see that the chart looks very similar. But in a less volatile moving market, I use a less volatile moving average. And so that's why I have the 20-day up there. But nonetheless, same look, below the 5-day, below my 30% line, not quite to the 50% line. But why is this significant? So let's bring back in and let's box out the year. S&P, I talked about initially below the 5-day. Bollinger Bands are coming inward, representing a potential mean reversion move. I use my Fibonacci tools to show me my 30 to 50% areas. I see that same look in the NASDAQ, the Russell, and the 10-year. Now, the 10-year, what's interesting is if you go back to last year and we talk about the Fed, and everyone was talking about how the Fed now all of a sudden dot plot for 3 rate cuts next year. And then you've got CME Fed Watch tool, which indicates the possibility of 6 rate cuts. So the market really took that and said the Fed is going to be pivoting here. We're going to have a lot of rate cuts next year. And the market took that as a bullish. You could take that the way you want. Whether you agree with that or not, it really doesn't matter. The market took it that way. And ultimately what happened was we had a really strong end of the year. And I think that was definitely contributing to what I would think seasonality and end of the year flows were. So you just had this really strong move. Now that the 10-year is backing up a little bit with the indexes, you have that same look on a technical basis across the board. And so that's extremely important. So it goes back to my mindset of slow things down. The look has changed. The whole look has really changed from December 30th to December 31st and onward. We've had weakness come into the market. And so I look at it like this. I want to be directional in where the stronger hands are. And the stronger hands are the people that are going to make that move early. And the weak hands are ones that are going to make it late, right? And we'll see what happens with the market. If you've been sitting long stocks or what have you, eventually they might start coming to the market. But the stronger hands realize change. That's the one thing about being the difference between a trader and somebody who's maybe an investor, right? Traders, when they see change and the market changes, they react as the change appears right in front of them. And that's what we saw at the end of last year. As bullish as I was in December, as bearish as I have to be right now, because the look has changed and it could change again, and I have to be ready to go with it. So my mindset is, if the look has changed, let me be directional with that look. Why am I going to try and fade this intraday? Why am I going to try and trade a two-way tape intraday? It doesn't make any sense to me. Because in the past, I'll overtrade, overchurn in a January, thinking too much, trying to do too much. You got all that, everything that happened in December in your mind for January, instead of just saying, this is what January's been. It has been a weak looking month across the board. It has been a sell the rally type market. So all I've been doing is staying really small, stay short. When the rallies come, I look to sell, take some risk off, and rotate out of my positions. And Tom will bring you back in because I want to go to my shorter term stuff next to show how I execute this. But, I write down plan, then execute the plan. Most traders are coming in, they're doing their big picture homework where the bigger hands are, then they get in the short term and they're fading it. And that's where I think that January effect gets a lot of people turned around. They're trying to do too much instead of just saying, look it, charts are bearish. Maybe yours aren't and mine are, but nonetheless, trade your plan.
Well, Anthony, I really like, your analysis of where you start to where you end up to the bonds. What's really interesting, I think, is what you said about what the Fed is doing and what the market expects the Fed to do in this year. It's surprising a little bit to me that the bonds are coming off a little bit. If I expect rate cuts, I'd expect bonds to continue this rise. Now, it's not necessarily out of a trend channel. Maybe it's consolidating a little bit, but bonds seem to be the smart market, maybe the leader. But regardless of all of that analysis, you're following what's happening on the screen, right? You're seeing that price is coming into your 70 to 50% area. It's below the moving average, similar to the E-mini S&P. Very much. I mean, you could almost put them side by side, and you might not be able to tell which one is which unless you really, know the market. But I think that's a great analysis of looking at all the indices and then switching over to bonds to see, kind of what that guide is.
I can't stress this enough, everybody. When all of the indexes have the same look, it doesn't matter what your strategy is. You could use my strategy, you could not. It doesn't matter to me. But anytime you see on your plan, on your daily bigger picture charts, the same look across all the market indexes, and also that other market that's not typically correlated with your market, like the ZN. And although you may look back and say that it is on an overall basis, and that's, once again, that's based in the eye of the beholder, right? Ultimately, you look at that other market that is driving your market, which is bonds and treasuries. If that chart looks the same as well, would understand that when ZN goes down, that means the rates go up. That's a factor in your market as well, right? And so why go against that? And here's the thing is that, I want to talk about this even more because I think that the overthinking in January of what it will be is way too much. And I think this really feeds down into the short-term scalpers. So first of all, scalping is a little different now. I've talked about this on the show than when I did it versus what it is now. When I scalped size for a couple of ticks here and there. And that was nowadays scalpers, because the equity indexes move the way that they are, they call themselves scalpers and they're trading for 2 to 4 points. But nonetheless, when you look at a short-term intraday scalper, which I know, like I said, there's going to be different the definitions of that. Why go against the primary trend of what the primary trend is right now? And so my thought process is, anytime that I have daily charts that tell me that I want to be short across the board, all the indexes are working together. When I really became the best scalper I could have ever become was when I recognized the bigger picture superseded the short term, and I only scalped in that direction with size. So I would wait, on a day like today or yesterday or the day before, and I would sell the rallies with size, and I try to scalp in that direction. I would not scalp against the grain. And so where I think a lot of day traders get themselves into trouble is they look and they see a bearish daily chart and they see that the market has now turned bearish. And a lot of times they find themselves trying to scalp long because it's getting to support first versus just waiting for the short scalp. And that's the mindset that gets you just all twisted and turned around. And I can tell you this, for longevity in this business, you've got to look at the bigger picture first, take it down to the shorter term, and that will slow things down for you. Remember my themes: slow things down, get into rhythm, get into good decision-making mode. And if you keep fading your plan, or if you're trying to go against the primary trend of the current moment, then you're just going to keep getting turned around. Then you're always chasing and you build this, anxiety almost within the market. And to me, that's the mistake I see over and over and over and over again. They just don't slow things down. And I go back to it. It's just about ease your way into the year, build that good decision making, because at some point there's going to be time where you're going to be able to increase your size, where all of a sudden things are going really well and you built that good rhythm, and then all of a sudden your execution becomes flawless. I've talked about this before. The first time I made six figures in a day was a nothing day in the E-mini S&P. It was a 15-point range at most. And I just traded unbelievably well. Why? Because I was in perfect rhythm. There were so many days prior to that where the market was 10 times as busy as it was on that particular day. But on that day, I owned it. Everything I did was right. I waited, I executed perfectly, I executed with size, I scaled out perfectly, waited for the next moment, did it again. And the market just gave me everything I asked for. You can't plan that day. That day cannot be planned. You don't know when it's going to come. So in order for you to get to that point of achieving that day that you want to get, you just got to put the work in. You've got to build good rhythm. It's the most understated thing because for me, it sets the tone, not only for the month of January, but for the year. And my best years have been the years I've just built and built and built, and I've removed a lot of the fluctuation. And there's going to be fluctuation in your P&L throughout the year. But the best thing you could do is narrow that fluctuation. Take a lot of that downside out because that actually adds to the upside as you build your year.
So Anthony, you mentioned rhythm, and that example that you used with the really good trading day. How do you know when you have that rhythm? Is it just looking at the results of the day, or is it more of a feeling that you get that I can't explain it. Maybe you can't explain it, but how do you know that rhythm is something that you want to replicate for for the next days going forward?
I know exactly what you're saying. Well, it's, some people will call it like trading in the zone. And for me, it's that we all know when we're in a state of strong mental strength and we can really handle anything, and we look at what the market's doing and we see it in like this view of where I know just to be patient for this look. And I know that when it gets there, I know if I'm wrong immediately. I know if I'm right immediately. You built up this intuition by doing the right things over and over again. Good decision making is contagious. You continue to do it. And all of a sudden things start to happen and you just have this mental clarity, these moments where you look at the market and you're like, I just know not to be short right here. I know not to be long right here. And you get to those moments where all of a sudden you start really taking advantage of it in those moments. I've said many, many times, trading is an in-the-moment business. I don't care how much planning most of you do. Until you learn how to execute in the moment, you're never going to be a truly successful trader. Because we all know in the moment is where you make all of your bad decisions. All of your good decisions are made prior to you getting to the screen. I can't tell you how many times I've screwed up my own planning and thinking. When I finally get down to the screen, all of a sudden I'm long or short in some random spot. And you're like, dude, what are you doing? You're an idiot. Stop. That's coming from a place of weakness, right? I feel the need to do something, or I go and do something and I'm not in a mentally strong place. You build good trading psychology by following your plan. You get discipline by following your plan, by believing in your homework. It's amazing to me that somebody will be so bearish in their thinking and then they'll go in and next thing you know, they'll be long because the market broke and they didn't catch a short. Instead of saying, look it, This long might be okay here, or just dial your size down. If you're normally trading 10 lots, trade a 2 lot and lose a little bit. That's growth. That's where you really start to get, if you're making those decisions in the moment, that's when you start to recognize that you've really grown as a trader.
Awesome. Well, thanks for that. Yeah, I agree. In the zone is another term that I think people can relate to, and it doesn't come right away, right? If you're a new trader, this is something that isn't going to happen right away.
No. And so I want to take everybody to the short-term thing, and I want to talk about the auto-anchored VWAP to the beginning of the year and why I think that this is an important tool to use as well. This is going to be my guide for my positioning. I actually put in my Discord, I showed a couple of my trades that I took on NinjaTrader using Tradeovate, and I showed what I did over the last couple of sessions. And I've been doing very little, small, smart waiting, right? When you look at the E-mini S&P, this is the anchored VWAP to the year. So you could just put up, I have a 60-minute trading, 60-minute chart up, and it's just showing me the anchored VWAP to the first day of the year. And so why is this important? Because I think that the January effect, the January impact for traders is one of those things where you look at the trend, how we start the year can go for days, weeks, or even months, right? I mean, it could be 3 days, it could be 2 days. I don't know. I mean, right now it's continuing into day 3, and it might just continue for who knows how long. But that auto-anchored VWAP to the beginning of the year is really a key because it shows us where the volume is building. So down below it, you also have the cumulative delta. And what I look at on a regular basis is, what are we doing to the volume weighted average price anchored to the first day of the year? And you look at that every time we get to the VWAP, you're starting to see the selling pressure come in. It can't be any more clear than that. Look at this every single session. We get to the VWAP to the beginning of from the first day of the year, sellers come in. You get to the VWAP, sellers come in. And you look, you see it. It rallies up to the VWAP, sellers come in. Here we are. I'm actually working orders again to get short up in there later today. If we get up to it, tight stops. Once again, I've still been short. If all of a sudden I see volume building above the VWAP and it starts holding above it on an hourly close or a daily close, I start rethinking what I'm doing. But until then, I'm just going to continue to sell the rallies because the responses have been what I'm looking for. Let's also go to the NASDAQ. It's the same thing. Rally up to the VWAP, sellers come in. Rally up to the VWAP, sellers come in. And it's important to look at this cumulative delta because it really does show you that that's why the volume weighted average price is coming down and that the market's actually respecting it. There's times that a VWAP doesn't mean anything. It doesn't mean anything. And people will look at it and they'll just trade off of it. Well, no. When it matters, trade off of it. When it doesn't, don't. And that's why I look at the volume. What's the volume telling me? You look at the Russell, same thing. Russell gets below the VWAP, bang. Sellers come in. It is just, it can't be more clear to me. I see it every day, right? And you look at the ZN. So my biggest, well, I've only been in one position in the ES, but my one loss so far this year is in ZN. I was actually short, and I was using actually the 10-year micro treasuries, not ZN. It's the 10-year yield. I've talked about this on the show, and I was trading that because I was trading the yield. My loss this year where I took a hit was I wasn't selling ZN. I was buying 10-year micros at this point when the ZN got up to that VWAP and it got tagged above it. So yesterday I got stopped out on that. And then this morning you see it comes back in again. But I'm going to continue to look at it. This morning I didn't get shorted. It happened just well before I was up this morning. So it is what it is. But if it gets back up here again today, I might take a look at shorting ZN or buying the 10-year micro treasuries. And to me, I'm just going to continue to trade these looks. And this VWAP is a guide. Remember, it's not that I'm trading the VWAP here. The VWAP is a guide from the beginning of the year as to what we're doing, all based upon what I showed you here. The Bollinger Band set the tone for me. The 5-day moving average, getting below that, as measly and simple as it is. Look at that in the NASDAQ, Russell, 10-year. When I see it on a technical basis on a daily, I take that down to my shorter term and go, okay, is the volume proving to me what the daily is? And yes, and yes, and yes, and yes, it is. So that's the important part about trading. It's about to take your plan and then have it come down to your shorter term and look at that proof. And if that proof is working, capitalize on it.
Anthony, that's great information. I love it. Just really admire the way you look at big picture to small picture view. And hope that viewers get to see this as well. Because it makes a lot of sense what you're doing. So thank you for that. A little bit of business to finish up.
Yeah, I want to mention the CME Group micro gold contracts. I see so many people out there talking about trading the gold market, and I would guarantee that most of these newer traders, the gold market is either too expensive for them to trade, or it's a new market to them, and maybe it's too volatile. Look at the micro gold. The micro gold has been around a long time. I think it's a great product. I saw some people talking about it on Twitter the other day. I said, you know what? I just want to make sure that people know about this futures product, because I think that it's 1/10 the size of gold. And so you're looking at $1 a tick versus $10 a tick, and the way that gold's moving, I think, especially if you're a newer trader with a smaller account, this is the place for you to go. Don't over leverage yourself by trading the bigger gold contracts until you've earned that right to be able to trade those bigger contracts. There's no harm in being small. I talked about it myself, even in a tweet. I'm trading really small, and it's funny. I've had nothing but winners at the beginning of the year so far in the S&P, except for that loser that I had, in the 10-year. And of course, everything is smaller than normal, but it doesn't matter. It doesn't matter. It's just about making money. It's about not being over leveraged. You want to grow as a trader in this business. You got to build rhythm, and you've got to continue to understand that. Just start building that rhythm, building that routine, and that's why I like to mention these micro products, because I think they're great for traders to be able to have a stronger hand in their positions.
Yeah, exactly. And for new traders, it's a good bridge between simulated trading account to going into real life trading with the micros. Probably your best bet to get your feet wet and feel comfortable trying to get to the zone that Anthony mentioned before.
Yep, no doubt. And one only thing I want to add to develop your edges here is I've talked a lot about the Discord. We're going to have a designated channel in our Discord for Develop Your Edge to follow up the conversations. That'll be launching later this month. There will be a link in the description on my YouTube. You could also go to my social media page, click on my link tree, make sure it's me, and go and join the Discord. It's free. My daily note is in there every morning on what I'm looking at for the markets. We've got an absolutely fantastic community in there. So hopefully you'll join us there in the Discord.
Awesome. Thanks so much, Anthony. That's, again, always a pleasure to be with you. And we'll do this again next week.
That's right.
Awesome. Can't wait. I want to thank the viewer for coming. And we'll finish the day with Mike Burke, his great analysis at bars closing 3:15. In the meantime, have a great trading day.